S. Relationship among capital expenditure budget, cash budget, and pro forma financial statements. Capital expenditures significantly affect cash flows. Large asset purchases require cash outlays or financing arrangements, directly impacting the cash budget and liquidity planning. Pro forma financial statements reflect capital investment effects. New assets increase non-current assets on the balance sheet and generate depreciation expense on the income statement, influencing profitability and financial position. Integrated planning ensures financial stability. Coordinating capital expenditures with cash forecasts and projected statements prevents liquidity shortages and ensures strategic investments are financially sustainable. T. Define the purposes of a cash budget and its relationship to other budgets. The cash budget forecasts cash inflows and outflows. Its primary purpose is to ensure sufficient liquidity to meet obligations while minimizing idle cash balances. It highlights potential shortages or surpluses. T. Integrates information from all other budgets. Cash collections are derived from the sales budget and credit policy assumptions, while cash disbursements come from materials purchases, labor, overhead, capital expenditures, and operating expenses. IT supports financing and investment decisions. Anticipated deficits may require borrowing, while surpluses may allow debt repayment or investment, ensuring effective treasury management. U. Relationship between credit policies, purchasing policies, and the cash budget. Credit policies influence cash inflows. The proportion of credit sales and collection patterns determine the timing of cash receipts. Stricter credit terms accelerate inflows but may reduce sales volume. Purchasing and payables policies affect cash outflows. Supplier payment terms determine when cash disbursements occur. Extended credit terms improve short-term liquidity but may reduce supplier discounts. Policy coordination improves liquidity management. Aligning receivable collections with payable schedules helps smooth cash flows and minimize borrowing costs within the cash budgeting framework. 5. Prepare a cash budget. Cash budgeting begins with estimating inflows. Managers project collections from current and prior period sales, considering credit terms and expected bad debts. Additional inflows may include asset sales or financing proceeds. Cash outflows are systematically scheduled. Payments for materials, labor, overhead, selling and administrative expenses, capital expenditures, taxes, and dividends are incorporated according to payment timing. Ending cash balance determines financing needs. Beginning cash plus inflows minus outflows equals ending cash. If below minimum requirements, borrowing is planned. If excess exists, repayment or investment decisions are considered.